Hello and welcome back to Make Money Guide. For many people, the word investing conjures up images of men in suits monitoring the exchange of millions of dollars on a stock ticker. You don't need to be the Wolf of Wall Street to start investing. It's okay if you're more of a mouse of Main Street. Even if you only have a few dollars to spare, your money will grow with compound interest. The key to building wealth is developing good habits, like regularly putting money away every month. Swap out the barista-made cappuccinos for coffees at home and you could already be saving more than $50 a month. Once you have a little money to play with, you can start to invest. In 2020, you can get a date, a ride, or a pizza with a swipe of a smartphone screen. Investing is no different. If you can automate your bills, why not your investments? It's just as easy. Today we're going to be talking about 7 easy ways to start investing with little money. Make sure you stay to the end as you don't want to miss any of this information. Make sure you subscribe to the channel and turn notices on so you don't miss any valuable content. Number 1, try the cookie jar approach. Saving money and investing it are closely connected. In order to invest money, you first have to save some up. That will take a lot less time than you think, and you can do it in very small steps. If you have never been a saver, you can start by putting away just $10 a week. That might not seem like a lot, but over the course of the year, it becomes over $500. Try putting $10 into an envelope, shoebox, a small safe, or even that legendary bank of the first resort, the cookie jar. Though this may sound silly, it's often a necessary first step. Get yourself into the habit of living on a little bit less than you earn and stash the savings away in safe places. The electronic equivalent of the cookie jar is the online savings account. It's separate from your checking account. The money can be withdrawn in 2 business days if you need it, but it's not linked to your debit card. Then, when the stash is large enough, you can take it out and move it into some actual investment vehicles. Start with small amounts of money and then increase as you get more comfortable with the process. It may be a matter of deciding not to go to McDonald's or passing on the movies and putting that money into the cooking jar instead. 2. Let a robo-advisor invest your money for you. Robo-advisors entered the investing scene about a decade ago and make investing as simple as accessible as possible. You don't need any prior investing experience, as robo-advisors take all of the guesswork out of investing. Robo-advisors work by asking a few simple questions to determine your goal and risk tolerance, and then investing your money in a highly diversified low-cost portfolio of stocks and bonds. Robo-advisors then use algorithms to continually rebalance your portfolio and optimize it for taxes. There's no easier way to get started in long-term investing. Most robo-advisors require just $500 or less to start investing and charge very modest fees based upon the size of your account. All offer automated investor plans to help you grow your balance. If there's any downloads to robo-advisors, it's cost. Robo-advisors charge an annual fee equal to a small percentage of your balance. The industry average is about 0.25%, so if you invest $10,000, you'll pay $25 a year. That's not a lot of money, but it begins to add up if you amass hundreds of thousands of dollars. 3. Start investing in the stock market with little money. When it comes to investing in the stock market, cost is often the barrier to entry. It takes money to make money, right? Not anymore. The internet has made it easy for consumers to get started with very little upfront money. That means you can put a few dollars in to familiarize yourself with investing before making a bigger commitment. It's a great way to learn about investing while putting in very little money at risk. Today, there are increasing numbers of options that have swung open doors to new generations of investors, letting you get started with as little as $1 and charges no trade commissions. In the past, stockbrokers charged commissions of several dollars every time you bought or sold stock. That made it cost prohibitive to invest in even a single stock with less than hundreds of thousands of dollars. In fact, $0 commissions across comp have been so successful they've disrupted the entire investing industry and forced all the major brokers, from E-Trade to Fidelity, to follow suit and drop trading commissions. Plus, the ability to invest in companies with fractional partial shares is a complete game changer with investing. With fractional shares, it means you can diversify your portfolio even more while saving money. Instead of investing in full share, you can buy a fraction of a share. If you want to invest in a high-priced stock like Apple, for instance, you can do so for a few dollars instead of shelling out the price for one full share. Number 4, dip your toe in the real estate market. Believe it or not, you no longer need a lot of money or even good credit to invest in real estate. A new category of investment known familiarly as real estate crowdfunding makes it possible to own fractional shares of large commercial properties without the headache of being a landlord. Crowdfunded real estate investments require larger minimum investments than robo-advisors, for example $5,000 instead of $500. They're also riskier investments because you'll be putting that entire $5,000 into one property rather than a diversified portfolio of hundreds of individual investments. The upside is owning a piece of a real physical asset that's not necessarily correlated with the stock market. As with robo-advisors, investing in real estate via a crowdfunding platform carries costs that you wouldn't pay if you bought a building yourself. But here the advantages are obvious. You share the cost and risk with other investors, and you have no responsibility for maintaining the property or even doing the paperwork to buy it. 5. Enroll in your employer's retirement plan. If you're on a tight budget, even the simple step of enrolling in your 401k or other employer retirement plan may seem beyond your reach, but you can begin investing in an employer-sponsored retirement plan with amounts so small you won't even notice them. This is one step that everybody should take. For example, plan to invest just 1% of your salary into the employee's plan. You probably won't even miss a contribution that small, but what makes it even easier is the tax deduction that you'll get for doing so will make the contribution even smaller. Once you commit to a 1% contribution, you can increase it gradually each year. For example, in year 2, you can increase your contribution to 2% of your pay. In year 3, you can increase your contribution to 3% of your pay, and so on. In the time you increases your annual pay rise, you'll notice the increased contribution even less. So if you get a 2% increase in pay, it will effectively be splitting the increase between your retirement plan and your checking account. And if your employer provides a matching contribution, that will make the arrangement even better. 6. Put your money in low initial investment mutual funds. Mutual funds are investment securities that allow you to invest in a portfolio of stocks and bonds with a single transaction, making them perfect for new investors. The trouble is many mutual fund companies require initial minimum investments of between $500 and $5,000. If you're a first-time investor with little money to invest, those minimums can be out of reach. But some mutual funds companies will waive the account minimums if you agree to automatic monthly investments of between $50 and $100. Automatic investing is a common feature with mutual fund and ETF IRA accounts. It's less common with taxable accounts, though it's always worth asking if it's available. An automatic investing arrangement is particularly convenient if you can do it through payroll savings. You can typically set up an automated deposit situation through your payroll in much the same way that you do with an employer-sponsored retirement plan. Just ask your human resources department how to set it up. 7. Play it safe with Treasury securities. Not many small investors begin their investment journey with US Treasury securities, but you can. You'll never get rich with these securities, but it's an extremely safe place to park your money and earn at least some interest until you are ready to go into higher risk, higher return investments. Treasury securities, also known as savings bonds, are easy to buy through the US Treasury's bond portal, Treasury Direct. There you can buy fixed income US government securities with maturities of anywhere from 30 days to 30 years in denominations as low as $100. You can also use Treasury Direct to buy Treasury inflation protected securities, or TIPS. These not only pay interest, but they also make periodic principal adjustments to account for inflation based on changes in the consumer price index. And as is the case with mutual funds, you can also arrange to have your Treasury Direct account funded through payroll savings. Unfortunately, the yields on treasuries have been getting closer and closer to 0% for a while now, and there's no end in sight to their lackluster performance. This makes Treasury mostly a place you stash cash for safekeeping rather than a way to grow your money. Which of the above methods have you used, and has it worked for you? Ensure to tell us in the comment section below. While you are here, go ahead and click on one of these 2 videos on your screen. See you there.